Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
We've been looking a lot at the push into artificial intelligence. It makes sense for the last 3 years. We've also seen more recently the talent grab and the war that is underway. On that, Bloomberg's Mark Gurman reported Meta has poached Alan Dye. He's Apple's most prominent design executive in a major coup that underscores a push by the social networking giant into AI-equipped consumer devices. And we see this playing out in a big way. Meta been paying up really big time, too, for some of those AI executives. Always a go-to on Apple and so much more when it comes to technology. Great to have back with us is Gene Munster, co-founder and managing partner at Deepwater Asset Management. They've got about $580 million in assets under management. Joining us, I believe, once again from Minneapolis, Minnesota. Gene, good to have you here. How are you?
Oh, I'm doing great. And I just want to do a shout out to your Mark Gurman. What an amazing job that he does, not just today with his breaking this talent move, but it just feels like week in, week out, he gets it done. So great work, Mark. And I think it just speaks to the news cycle around AI this week. You know, each week it's a high bar, and each week it seems to deliver for us, Carol. And we got big news this week.
Yeah, listen, we're all head of the fan club of Mark Gurman because he is unbelievable in terms of his insight on that company. What do you make of the talent grab, and especially things moving around from Apple? You know, Apple has often been sometimes criticized for being behind when it comes to the AI curve. Others say maybe they're waiting for the models and all of it to play out rather than doing the big spend now. But tell us about the talent grab and how you see Apple, whether they're losing in this or they're doing okay.
Well, I think Apple's doing a reset in terms of how they're thinking about talent, just not only around design, but of course AI and the news that the head of AI is retiring. Essentially, I think he was asked to retire. And then, of course, we have Alan Dye and his move over to Meta. And I think that those are related. If Apple wanted to keep Alan, they would have. And my sense is that the pay package is probably worth over 5 years, $500 million. Wow. It's a big number, but he could have earned and been rewarded options with Apple stock. And if they wanted to keep him, they could have. But if you kind of just look at the big picture here, is that these two departures, the timing of them, I think speaks to essentially a reset that Cook is undergoing. And so I think that that's one piece to it. The second is that it is, even though Apple wasn't desperately trying to keep Alan, I think it is a coup for Meta. I mean, this is probably one of the top 3 talents in the world in terms of design behind Johnny Ive, and I think that they're obviously paying up, and it speaks also to a reset that's been going on with inside Meta. We talked about how Cook is kind of resetting the AI on the design team at Meta. They're kind of resetting the framework around Reality Labs. And as a quick reminder, this is their segment that does virtual reality, mixed reality. This is where the Quest goggles are in, and their wearables, what they're doing with Ray-Ban is all part of that.
So when you say reset, yeah, go ahead, Gene.
Yeah. They're losing a lot of money within that, this right. $19 to $22 billion a year. So the reset, I can kind of define what that reset looks like, but I think there are some very big, important moves within these two companies that have gone on this week.
Do you think the reset also involves possibly Tim Cook stepping down as CEO? Will he then just become chairman of the board there at Apple?
So that it's eventually he will. I think he's around 65,
I believe. Yeah,
65. And so, I mean, that is on the horizon. My sense is that it's probably at the end of the Trump administration where he would actually try to exit. I think, he has been the whisperer at the White House, and that's been an important role he's played as a statesman. And then on top of these changes that have happened on their design team and within AI, I think it's important that he's around. So my sense is it's probably 2-3 years away before we hear anything on that front. And so I think they're grooming a team to take the reins there, and so I think Apple investors at least, can sleep well at night, at least for the next couple of years, knowing that Cook is still going to be in charge.
Gene, go back to this reset of both Meta and Apple. It sounds like you're saying that these two companies are kind of looking at themselves and figuring out, where they need to be for the future. Talk to us a little bit more about this reset of the two.
Well, on the Apple side, the reset is just to get the products to work beyond this functioning Siri. And of course, that's the bar. Apple has appropriately raised a very high bar for what the new Siri, and for your listeners, when you hear about the new Siri, it's code for the new Apple Intelligence. It's code for a reset of all that they've done. And really an opportunity for them to kind of reset customer expectations. But beyond that new Siri, which presumably is still on track for the spring, that's that reset, is trying to find new ways. I think he's looking for new ideas in terms of how to infuse AI across their products. So that's what's going on in Apple. In terms of Meta, we kind of roll it back and look at how Zuckerberg described in 2021 when they changed the name to Meta. His comments about the metaverse were basically this immersive internet. That's how he referred to it as. It was very VR centric. That was Reality Labs, and that's where they'd been spending that losing 15 to 20 billion a year. Back in September, when they announced the new glasses, this Ray-Ban glasses, the Meta display glasses, he talked about the metaverse. He defined it as a mix of AI and holograms on the real world. It was not this immersive kind of closed off experience. And so I think the reset that's going on within Zuckerberg's definition of the metaverse is away from VR. I don't think anybody's going to be heartbroken over this, but away from VR and more, bringing Alan Dion is more to really nail some glasses and hardware design, software design around these wearables future.
Hey, we do have something crossing the Bloomberg, and I want to see if we can get you to weigh in on this. It's coming from the FT, and they're citing a bill seen on the NVIDIA chip block proposal, and that U.S. senators are looking to stop NVIDIA advanced chip sales to China. So this bipartisan bill would bar NVIDIA's H200 Blackwell chips. Again, from the FT, this war with China, the role of NVIDIA, advanced chips. How important is it that we do restrict some of this technology, especially these high-end chips from NVIDIA or others, when it comes to China?
So it's almost like a religious question. Well-minded people on both sides have very different opinions. My view is that China will find a way to develop the most advanced chips. I have the same opinion that Jensen has, that ultimately is that if we don't sell some form of chips to China, they'll just go and create their own, and we can benefit in the near term of having them dependent on our platform. If you think of like NVIDIA, for example, it's not just the chip. They have a CUDA development platform. And so getting their developers based on that does give the U.S. some form of leverage in terms of how the technology rolls out in the years to come. And so my sense is the best thing is to allow limited sales, some somewhat metered back, governed back chips to China. I think that is a win. In terms of NVIDIA stock, it's a negative headline. We get kind of these positive headlines that there's going to be some sort of resurrection in their China business, and then we hear what you're talking about that just hit. And I think that the answer is that the street estimates right now don't include any China revenue, and my sense is that Jensen has talked about that business being a $50 billion a year business, so kind of adding 20% to their overall revenue. I think eventually it does get turned back on.
I just want to mention NVIDIA shares, like the overall market, off their highs of the day, but still up. Alexis, up about 1.7%.
Yeah, I mean, and also NVIDIA's CEO was in Washington just yesterday. He left. I don't know if he left with the feeling that maybe it was going to go his way, but this certainly doesn't seem like it might go his way. What are the implications, do you think, though, Gene, for the chip sector in general? I mean, beyond NVIDIA, if this bill were to pass?
Well, I think any legislation that slows down the development, I haven't seen the details of it, but if this does create some form of restrictions on build out. If it's just China related, that's generally a neutral to the AI trade. But anything that would slow down any restrictions on chips, there's obviously a compounding effect. For every dollar that's spent on chip, there's another 9 that's spent on other infrastructure around it. And so that's one thing to look at is, can this ultimately slow some of that? My sense is that the big picture is I still believe, I probably need to preface this comment, is I consider myself try to look at different views and be well-grounded. And I still believe we're in the second inning of this AI build-out. I don't want to get involved in all of the hype cycle, but back to this, what we're seeing this news today is that this is essentially just dressing. This is the ripple of the day. The underlying tide still is undeniable, is that we still are, the size of the brain is getting bigger, the hardware piece, the infrastructure of AI brain, and the applications and the use case and the transformation will inevitably follow. And so I generally think, like any headlines like this, don't change the inevitable piece, which we still have, I think, multiple years left of better than expected, higher growth rates around a lot of this AI infrastructure.
And I just want to add, just because, as you said, and we appreciate you weighing in on these FT headlines because it's a little bit of information, just a little bit more to add. It's called the Secure and Feasible Export CHIPS Act. It would require the Commerce Department to deny export licenses for advanced chips to China for 30 months. And again, from the FT. But what I want to go back to is what you say about the AI build out, which I do feel like there's this push and pull when it comes to where we are going with this. Some concerns about the circular financing and some concerns about just the spend overall. This AI build out, you have conviction and you say, early in terms of the innings, more years to come. What gives you that conviction? What makes you so sure? Because some are questioning whether the ROI will be there for everyone in terms of the spend.
Yeah, the numbers, they become numbing, but I'll just quickly recap. We're talking about $1 trillion infrastructure spending over a few years, and there's nothing even that compares to that. So how do you get an ROI on that? And my basic sense is that if you just kind of think about like humanity, I think that the most valuable thing that humanity has, maybe beyond love, is some sort of form of an insight. And if AI, in fact, does deliver insight, it's not there today, but if we do move to something, we don't have to necessarily get to general intelligence, but if you do get to general intelligence and beyond, I think that the value on that is going to be hard to quantify. And so that is, it's a pretty soft bull case in some respects, but in other ways it's most compelling because humanity's never seen anything like this. And if you look at, listen to comments from the biggest companies, they're still talking about pretty elementary uses of AI. Jensen most recently was talking about the importance of coding or customer service. This is 3 years in it, we're still talking about that. You can read that as a most bullish comment regarding AI, that we're just scratching the surface. You could read it as a comment that is ultimately a sign that there's never going to be any ROI. My sense is intelligence at scale is infinitely valuable to humanity and is going to continue to power this trade higher.
All right. With all the companies that you cover, that you followed for years, yes, the Mag 7 and others, is there one tech company out there that you really feel like we all should be continuously watching?
Well, she's asking for your favorite child.
Yeah.
Sorry, Gene.
It's the right question. I think that outside of the obvious ones, maybe to answer a slightly different question,
sure.
Outside of the obvious, what's a company that is going to be a big part of conversations in the future? It's just starting to grow. I think a company like Anduril. We hold it in our one of our venture funds. Of course, that's a well-known company, but I think can have just a profound impact on humanity and how conflict is resolved and not only just a growth story for that company. There was recently a story in the Wall Street Journal about some of their struggles in terms of getting the products to work, and I think it misses the point that there is going to be a transformation around defense, but that's kind of below the Mag 7. If I could just put a word in for, I think Apple's probably the best performing Mag 7 over the next 6 months and probably Google over the next year.
Yeah, and Alphabet certainly has been outperforming this year when you look at the Mag 7 already, and Apple's up about 12% year to date. Gene, always great to get some time with you. Thank you so much. And if we don't catch you before the new year, Happy New Year and Happy Holidays. That, of course, is Gene Munster, co-founder and managing partner at Deepwater Asset Management. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get to Meta. We are seeing shares rallying today. A top performer in the NASDAQ 100. It's all thanks to a Bloomberg scoop by our own Kurt Wagner. He joins us now from our Bloomberg News San Francisco bureau and studio. Kurt, great reporting. Tell us about Meta and kind of going in reverse when it comes to the Metaverse.
Yeah, so this is something that has come out of conversations over the last several weeks. At the executive level at the company, they're doing 2026 budget planning. And Mark Zuckerberg has sort of asked executives across the board to generally look for 10% cuts. You know, how do we trim things down, head into next year a little slimmer? But for the Metaverse group specifically, he's asked for a lot more. And my understanding is that executives are still figuring out exactly how deep they're going to go, but that they're talking about cutting the budget by as much as 30% next year. And so for a company that has, touted the Metaverse as the future of this business, right? I mean, they literally changed the name from Facebook Inc. to Meta Platforms Inc. a few years ago. It's a notable decision that they are pulling back. They're not getting rid of the Metaverse stuff, but they are pulling back in a meaningful way.
I'm glad you said they're not getting rid of the Metaverse stuff. What does that consist of? I'm thinking of like virtual reality type stuff, the cool wonky glasses. Are those things still going to be there?
Yeah, you're right. So there is a little bit of confusion because Reality Labs, which is this sort of futuristic unit within Meta, does a whole bunch of stuff. They do the AI glasses, the display glasses that they showed off in September. But then they also do sort of the Metaverse group, which I would bucket into two things. One is the VR headsets, the Quest sort of immersive headsets, and then Horizon Worlds, which is the virtual world software product that they develop. And so my understanding is this 30% budget cut is really in that Metaverse specific bucket. So I imagine we'll see some deep cuts into VR and Quest. We'll see cuts into the Meta Horizon Worlds product, more so than the actual AI glasses, those Ray-Bans. That's something I think they think is performing well. And actually, I'm told that some of the savings from the Metaverse stuff will be funneled over toward the AI glasses and other types of wearables in that department.
Totally makes sense. Just got about 30, 40 seconds here, Kurt. I think about when they went public, right? And they had to pivot quickly to mobile, right? Because they were kind of penalized for not being there in that space. Is this just a company saying, okay, maybe it isn't the Metaverse. We're pivoting to what makes sense. We're listening to investors and analysts, and just got about 30 seconds.
I mean, think about what's changed in the last 4 years since that company name change, right? Back then, AI models, building multi-billion-dollar data centers wasn't the thing. The Ray-Ban Metas weren't a thing. So a lot has changed for them in that short amount of time. And quite frankly, they've probably found that there are other better ways to be spending these billions of dollars right now. So again, not getting rid of it entirely, but better uses of the money.
Might Meta AI name change be around the corner?
I hope you cover that and not me if that's the case. So.
Great stuff. Congratulations. A scoop and exclusive by our own Kurt Wagner. He's Bloomberg News senior tech reporter covering social media.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I've been driving all night, my hands wet on the wheel.
Come on, let's take a drive.
A drive?
Yeah, a drive.
Can you just focus on driving? Focus on the road.
Why would I drive fast?
Because I'm asking you to.
Just take your place in the driver's seat. Just drive, baby. Driver's seat.
This is the Drive to the Close.
But we're going, we don't need roads.
On Bloomberg Radio.
All right, everybody, we've got just about 19 minutes to go until we wrap up the trade on this Thursday. Carol Master along with Alexis Christophorus in for Tim Stanovic. Kind of interesting in terms of the trade. Bill and Charlie just breaking it down, Alexis, just down about 6-7 points on the S&P 500 and the NASDAQ 100, decline of about 85 points, down 1/3 of 1%.
Yeah, I mean, as Paul Sweeney would say of Bloomberg Intelligence, it's a nothing burger right now as we wait for the Fed next week.
All right, so we want to talk about that with Jimmy Lee. Great to have him here in studio, usually out in Vegas. He's founder and CEO of the Wealth Consulting Group. They've got about $6.7 billion in assets under management. How are you?
Great. Thanks for having me. Great to see you.
It's great to see you. I was saying, I asked you in the break before we got going, good year?
It's been a great year. Yes, because I think that in April when things were not so great as far as the markets and investor psychology, we thought that this could look like another V-shaped recovery like COVID, which has played out.
Yeah.
And we've seen a lot of other, outside of Max.
Did you get out before?
No, we're not market
Liberation
timers.
Day?
We do have
you rode all of it.
We do have some tactical portfolios, but we definitely didn't go down as much in all of our models. We were just underweight a lot of the big names that got hit the most during that time period.
The Liberation Day time period we're talking about, right? When tariffs were announced back in April.
Correct. That's correct. And so it's actually been a great year, and we've got a decent allocation overseas. International markets have done really well this year, as you know. Small caps are starting to come back.
Yeah,
that's part of our story. I'm hopeful that interest rates will be lower than maybe predicted. And I think that small businesses that are suffering right now, we saw with the recent jobs report, I'm hoping for a recovery.
I'm hearing diversification, although we didn't say the word, right? But basically, you have a lovely diversified situation where you are.
Yes, we like tech on the dips and on sell-offs, but we think
buying like the Mag 7 on sell-offs.
Maybe not all, but some on the sell-offs.
Okay.
But we like other areas that provide value, right?
What are they?
Well, you were just even talking about some of these retailers, right? We saw Dollar General, Walmart.
Yeah.
I mean, value shopping is in vogue at the moment across the board. And so I think that in the investment space, I think investors that might take some of that $8 trillion on the sidelines could move that money into longer duration assets such as bonds, equities, and I think they'll look for value. And this is a hated bull market, as you know.
Yes.
A lot of people have missed it, as evidenced by that $8 trillion.
There's a lot of FOMO out there still. So speaking of which, you still have you say 7,000 on the S&P is still doable by end of year. So we're about 6,800 now. So what would get us to 7,000?
I think this high beta trade that's been sold off, if we get a little bit of a change in sentiment, for sure the Fed cutting will help a little bit. I think that's been now priced in again. But I think we get a little bit more of a risk-on attitude with the idea that, this ultra pessimism we like. And I think that there could be a lot of this money that goes into the market as we see some tax loss harvesting happening at the end of this year. Money's going to be added. I think people could take positions. But it's, I think, a little bit more sentiment.
You say hated bull market. Having said that, I'm looking at a VIX that's at under 16. There's a lot of complacency out there. Or is it marking time or something?
It's kind of a weak tug of war right now, right? So meaning that there are a lot of people that want the market to go down, that have been saying the market's going to go down a lot. They're saying that, equity prices are too high, valuations are too high, there's an AI bubble, there's a private credit risk problem, all these things. And then on the other side...
Could they be right?
Well, I think so. I mean, some areas, but I think we believe on the other side of that. And I think there are a lot of macro tailwinds that will come to fruition in 2026. And, we passed, I think, a lot of the uncertainty with tariffs, which was the cause of a lot of volatility earlier on this year, as you know. And I think, deregulation and the activity that might pick up with lower rates, especially if the mortgage rates come down, if the housing market unlocks, I think that's what really changes psychology of the investor. Sentiment gets better. We could have a melt up even further, which then I would imagine we'd get some corrections maybe in volatility then.
What do you do with the AI trade, and have you pulled back?
That's an interesting one. We still believe that we're not near the end of the spend, but it's more about, is that money going to turn into profitability at some point? And I would say that I'm more in the camp of there's going to be good news and more stories where companies are going to start to report, maybe as early as next year, productivity results on that spend. Now, how that turns into maybe more jobs and GDP growth, we'll see. But I think it's really the small businesses, as you saw in the last report, that have really been kind of pulling back. And I think those are the
ADP report you're talking about.
Yes, and, it's small businesses and the consumers that really, depend on consumer debt, right? They're paying high interest. That if interest rates come down, I think that, especially with housing, if we get people that are wanting to sell their homes and buy new homes, I think that'll change a lot of the sentiment next year.
What if we don't get rate cuts next year? Our Ira Jersey, our interest rate strategist here at Bloomberg Intelligence, he said, expectations are we get that cut next week, but then nothing happens until May of next year. Part of me says that means maybe we don't need it. But it also says to me, it could be that there are inflationary pressures because there's going to be another liquidity push that comes into the market because of those tax cuts, because of some of the other things in terms of the regulatory environment. So I'm just curious.
Yes, I think that
is that like a big risk?
It's a risk, but I think that if I was a betting person, that there could be more cuts than predicted.
Because of Kevin Hassett?
That could be it. Yes, it's going to be a little bit, maybe if you think about politics, that could play into it.
It's not just he's got one vote, though, right?
That is very true.
True. But
it's getting stacked. The Fed is becoming very quickly stacked. Folks who are going to side, if I could say that, side with the White House.
But this whole thing about inflation needing to be at 2%. I mean, I think
they move the target?
I mean, they could, but I don't think that's going to happen. I think it's more about jobs. I think that there's absolutely a slowing economy, right? We've had a lot of, we're not growing the economy with lots of new jobs yet. And we know that with AI, companies are kind of putting a hold on maybe a lot of new hires in mass. And so I think that we need the rates to come down so smaller businesses that aren't, spending the billions of dollars on AI and have more need for labor just to put people to work because there's demand for their products.
So you see the labor market as the bigger threat to economic growth and inflation?
100%.
In 2026. Okay. I don't know if you're convinced, Carol.
You don't seem super happy.
We're really happy because our clients have done really well because we've been, as you know, Carol, since I'm really glad to be back, but we've been on the bullish side. Now, the stock market's up 75% of the time, so it's probably easier to be more bullish. That being said, I think we really do have some big macro tailwinds. Think about interest rates coming down in a not a recessionary environment, right? That's causing that, but in a growing environment,
which is what you want,
right? With corporate profits expanding, margins were amazing, and I think that margins can continue to expand. Why? Because labor costs are kind of stabilized a bit.
30 seconds or less. What do you do with crypto in all of this? Where's its home?
I think it has a home. I'm not a crypto trader. And I wouldn't recommend people to it's like saying, what do you think of stocks, right? There's a lot of different types of crypto. So I would say that it deserves an allocation in many clients' portfolios. And I think this volatility that we've seen could be an entry point for some people that have missed it.
All right. Good stuff. So much fun to have you here and so much fun to talk to you throughout the year as we do. Looking forward to 2026 with you. Jimmy, be well.
Thank you. Happy holidays.
Yeah, you too. Jimmy Lee, founder and CEO of the Wealth Consulting Group, joining us right here in our Bloomberg Interactive Broker studio. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to go back to Ulta, which has certainly caught our attention. It was the subject of a recent Bloomberg Businessweek cover story. Ulta shares, just a reminder, up more than 5% here in the aftermarket. This is after the company came out with an upbeat outlook. And we want to dig a little bit more into the quarter.
We do. And to help us do that is Bloomberg News consumer reporter Jeanette Newman. Jeanette is joining us via Zoom. Jeanette, great to see you. So what is Ulta doing right? Let's start there because these are nice results.
They are good results. Kind of a really clean beat and raise. I mean, their net sales were up 13% in the most recent quarter. Some of that is because they acquired a UK and Irish beauty company that helped boost those results, but still really great numbers. And I think one of the things that they're doing well is Ulta has a really wide range of products. So they have kind of the low, the medium, and the high. So that can be, fragrances that cost $200, makeup that can cost about that much, all the way down to, lip gloss that could cost $5 or $6. And so one of the reasons that's important now is with some of this, unclear signals from consumers. Some consumers are trading down. You can still go to Ulta and trade down within Ulta, right? If you were buying that really expensive perfume last year, now you want to save some money, you can buy a less expensive perfume, but you don't need to leave Ulta to do that. So I think that's one of the reasons that it's doing particularly well right now.
Yeah, I think it's fascinating, just the whole beauty space. And you're right. It's quite a range. There's so much out there. In terms of commentary, we did see the CEO cautioning or saying that consumers remain watchful and they are seeking value as their wallets are pressured. And I feel like, Jeanette, you and the team have all been breaking down all of the retail earnings. That seems to be a common narrative. Even the retailers that do well, they're saying consumers are cautious.
That stood out exactly to me as well. It's like the net sales were up in the most recent quarter, 13%. Ulta raised its comparable sales. They're expecting now for the full year up 4.7% from up 3.5% that they had said in August. So just a few months ago. I mean, they're expecting to do much better, and yet still the CEO Kesha Steelman said, but we know consumers are being watchful, which just kind of seems at odds, right, with how the company actually did. And I think part of that is that we do still have a long way to go in the rest of the holiday shopping season. So I think, CEOs want to be cautious because of that. But I just think it speaks to this honestly kind of wacky world that we're living in, where you see consumer sentiment, hitting all-time lows, and yet we have a relatively good, robust Black Friday, and retailers that had been kind of cautioning about a slowdown heading into the holiday are actually posting relatively good results. So I just think it speaks to the volatility that all of these companies have lived with. I mean, since the pandemic, and they're now used to it and saying, okay, we can't call what's going to happen, in the economy. So we'll just make sure to couch any success with the idea that, it may not continue.
To get back to the idea of like what Ulta's doing right, they have this loyalty program, which is actually pretty good, because I know that I have a loyalty program from Sephora. And frankly, it's confusing, and I don't really feel like I get a lot out of it. Sorry, Sephora. But I think Ulta may have one up on Sephora there. I know Sephora's, not publicly traded. But I mean, things like the loyalty program, their online marketplace, are those like differentiators, you think, for Ulta?
I think their loyalty program is an incredibly popular loyalty program. And I'm not in either one, Sephora or Ulta, to be able to compare, but I do hear, similar to what you're saying, that people really like Ulta's loyalty program. And that's really been a focus, even for the prior CEO. And Steelman has continued that focus. So I do think that's something that's important, as well as you mentioned the online marketplace, that just allows, with the boom in beauty, during and then post-pandemic, people are just really into trying new products. That kind of discovery, that's really fun for a lot of people. And opening up that online marketplace allows people to do that via Ulta. And another thing to note is Ulta has also expanded internationally. And in that sense, it's kind of following more in Sephora's footsteps, becoming a more international business. Sephora obviously initially based in Europe and now all over the world. But Ulta's opening up in November, just last month, they opened up in Kuwait, and they're opening up in, I think it's Saudi Arabia and the United Arab Emirates earlier next year. So as some analysts have said, kind of firing on all cylinders, which the results today seem to also indicate.
Kind of cool. And Amanda Mull did a deep dive on the company for Bloomberg Businessweek, and the headline on it is how Ulta became an $11 billion beauty behemoth by conquering suburbs and acting like Home Depot, more so than like Sephora. So their model is definitely different. And you walk into a Sephora, it's a very different feel versus walking into an Ulta, but it seems to resonate.
It really does. It really does. And I think, again, it's as Amanda wrote, it's about, expanding in the suburbs. So when you're going, maybe to shop at Walmart, you also are going to go, pick up what you need at Ulta. And I think, there's obviously been the Sephora Kids phenomenon with younger women in particular going into Sephora, but that's a name. And there's also Ulta Kids as well. And to a certain extent, Ulta,
there's Ulta Kids. Did you know that?
No, I did not know this.
What is that?
No, sorry. I'm saying there is Sephora Kids, but that's just kind of like a broad umbrella term. No, I just coined it right now.
She coined a new thing here.
I'm like, the CEO, Ulta CEO is calling you right now. Like, hey, what's this about?
I mean, I think it's just the idea that younger people are not just shopping at Sephora, right?
Yeah.
It was kind of, I think the idea that younger people were shopping at Sephora stood out in part because the prices there are higher, and you normally think of that as a place where you would go when you have a little bit more money and you're maybe not just relying on your allowance to buy your beauty products. But these younger people are also shopping at Ulta. So it's a wider phenomenon than just Sephora. Younger people are really into beauty in a way, and cosmetics in a way that other generations at their age were not.
It's like skincare, for instance. They're spending so much on skincare. I never thought about it. When I was 12, I was not thinking about skincare. Maybe I should have been.
Yeah. Listen.
I mean, if I would have been as into sunscreen as people who are, 11 and 12 now are, my dermatologist would be out of a job. So
I agree. I look at all these young folks and they're just like, their skin's perfect. And then they're like, well, I need some cover up. I'm like, what are you covering up?
Exactly.
Jeanette, thank you so much. Really appreciate you walking through Ulta. Ulta shares up 5.25%. Bloomberg News consumer reporter Jeanette Newman.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.